5.3, mean due limited. Mean due limited. 5.3.1, calculate the missing figures indicated by 1 to 4 fixed asset note. 1 to 4. We want to calculate the missing figures indicated by 1 to 4. Let's start with 1. There is fixed assets there, that is provided the note for fixed asset, which is information A, page 18 of your November 2018 exam. 1, we need to calculate land and buildings, additions at cost for land and building. And there is a transaction there which says grant construction was paid 882,000 for land and building, for building new offices 610,000, and repairing windows 272,000. Even though the total amount paid was 882, but it was only 610 for building new offices and 272 was for repairs. So additions at cost is only 610. So Roman figure 1 is just 610,000. Additions at cost, you need not to be confused. Repairs cannot be regarded as addition. So additions is only refers to building new offices, that's 610,000. And then Roman figure 2. Roman figure 2, we want to calculate depreciation on computers. That's Roman figure 2. And according to information C on page 19, the 3 computers were all bought on the same day at 36,000 each. Depreciation is 33 and a third on cost, and these computers are expected to last another 2 years. So we want to calculate depreciation, and it's 33 and a third on cost. And if you look at the cost of the computers, the cost of the computers is 108,000 multiplied by 33 and a third. You're looking at something like 35,000 or 36,000 rents. You're looking at something like 35,999 or 36,000 rent. But if you look at the carrying value for computers there, the carrying value at the beginning is only 13,000. So therefore, it means you can no longer depreciate this equipment by 36,000 when already these computers have got a value of 13,000 rand. So for this calculation, depreciation for this year will be this 13,000 minus 1. So depreciation for this year will be 12,999. So according to the accounting principles, we are saying that these computers have now been fully depreciated, and we are no longer going to be calculating any depreciation going forward on these computers. Because if you look at the value now is 13,000, and depreciation every year is almost like 36,000 every year. So now if we are left with the value of 13,000, then you can't depreciate this with 13,000. And according to the principles of accounting, they are saying, it says at least we should leave an asset with a value of 1 rand. So if this asset has already having a value of 13,000, we can only depreciate it by 12,999 and leave it with a value of 1 rand. So the answer to Roman figure 2 is a depreciation of 12,999. Roman figure 3. Roman figure 3, that is equipment. We want to calculate depreciation on equipment. We want to calculate depreciation on equipment, and we are told here that additional equipment was purchased on 1 February 2018, and depreciation is calculated at 10% per annum on cost price. So at the beginning of the year, equipment, it was 1,250,000. 1,250,000. That's the cost price at the beginning, and we want to calculate depreciation for these equipments which were there from the beginning of the year. So 1,250,000. 1,250,000 will then give us 125,000. The depreciation for this asset will be 125,000. 10% on cost price. And then let's calculate depreciation for the new equipment that was purchased during the year. The new one. The new one that was purchased during the year, according to the fixed assets there, it was bought for 172,500. 172,500. And at 10% per annum. And let's calculate the number of months, because this one was not there from the beginning of the accounting period. This equipment was bought on the 1st of February. And our year ends on the 31st of May. So that's February, March, April, May. That's 4 months. So this new equipment, we have only used it for 4 months this year. So this 10% is per annum. So we want depreciation for only 4 months. So let's see how much will be the depreciation for 4 months. 172,500 multiplied by 10% multiplied by 4 months. That is 5,750. 5,750. Let me double check this. 172,500 multiplied by 10% multiplied by 4/12. 5,750. So this then brings us to the answer now for Roman figure 3. 5,750 plus 125,000. That is giving us 130,750. 130,750. So Roman figure 3 is 130,750. Our depreciation on equipment is 130,750. Roman figure 4, still on the same question for fixed asset note. We want to calculate Roman figure 4. Roman figure 4, what is it that we are calculating? We are calculating disposals at carrying value. The vehicle that was sold. Disposals at carrying value. Disposals at carrying value. The vehicle that was sold. And there is a transaction that is saying about vehicles that depreciation is 12% per annum on the carrying value. A vehicle was sold for cash at carrying value on the 31st of December 2017, and the fixed asset register reflected the following. The cost of the vehicle that was sold is 176,000. The cost is 176,000 of this vehicle, and the accumulated depreciation is 128,000. This vehicle has depreciated to 128,000. But this depreciation, this accumulated depreciation is on the 1st of June 2017. This is on the 1st of June 2017. 1 June 2017. And this asset was sold when? We are told that this asset was sold on the 31st of December 2017. So we have used this asset from June, July, August, September, October, November, December. It was sold on the 31st. We have used this asset for an additional 7 months, and we need to calculate depreciation for 7 months. And then depreciation for 7 months, we will then say 176,000 cost price minus accumulated depreciation of 128,000. Because we are using the carrying value method, equals to 48,000 multiplied by 20% multiplied by 7 months, 7/12. That's 5,600. Accumulated depreciation for 7 months is 5,600. So that tells us that the accumulated depreciation now on the date of sale will be 128,000 plus the 5,600 for 7 months that we have used the vehicle. 128,000 plus 5,600 will give us the accumulated depreciation of 133,600. 133,600. So the value of this vehicle on the date of sale, the value of the vehicle on the date of sale is 176,000. 176,000 minus 133,600 equals to 42,400. Disposal 42,400. If we sell this vehicle at the correct price, we will sell it for 42,400. Anything less than that will indicate that this asset was sold at a loss, and anything more than that will indicate that the asset was sold at a profit. The last one is Roman figure 5. This was Roman figure 4. And then the last one is Roman figure 5. Roman figure 5, we need to calculate the accumulated depreciation at the end. This one is the easiest one because we will take the accumulated depreciation at the beginning, which was 800,000, that's the beginning, plus depreciation for the year, which is 256,000, minus depreciation of the asset that was sold, which is 133,600. The student needs not to forget the depreciation of the asset that was sold. So at the beginning of the year, depreciation was 800,000 plus depreciation for the current year for the fixed asset, which is 256,000, minus 133,600 depreciation. 133,600 for the assets that was sold. So this final answer is 922,400. The final answer is 922,400. And 5.3.2. 5.3.2, explain how the internal auditor should check that movable fixed assets were not stolen. How the internal auditor should check that movable fixed assets were not stolen. Here you just need to do the physical count. Remember that the business needs to have the record of all fixed assets that it owns. So to ensure that these fixed assets are not stolen, it is important that the business needs to conduct regular physical count. Physical count comparing with the fixed asset register. The fixed asset register has got all the records of the stock of the fixed assets that we are having. So it is important that you do the regular physical count comparing the fixed asset register with the physical count, so that the business can detect at an early stage when there is a fixed asset that is missing. So to answer this question, how the internal auditor should check that movable fixed assets were not stolen, then the internal auditor should conduct physical count, regular physical count, and comparing the results with the fixed asset register. The last question, land and building, which is 5.3.3. Land and building were bought 5 years ago for 6 million. Property prices have increased by 20% since then. The directors want to increase the value of this asset and reflect a profit of 1,200,000 in the financial statement. As an independent auditor, what advice would you give? Provide 1 point. Land and buildings were bought 5 years ago for 6 million, and the property prices have increased by 20% since then. So the directors want to increase the value of this asset and reflect 1,200,000 in the financial statements. As an independent, what advice would you give? Provide 1 point. GAAP principle here. The advice that you will give will be, these people need to be referred to GAAP principle. GAAP principle, we have historical cost. There is a principle which is called historical cost. Assets must always be recorded at its original cost price. That is the principle. We cannot deviate from this principle. The historical cost principle, which is taken from the general accepted accounting practice, is the historical cost, which says assets must always be recorded at its original cost price. The profit of this asset will only be realized when the asset is sold. But when you are still having an asset, it must always, if it was purchased for 6 million, it must always be shown as 6 million in the records of the company. The profit will only be indicated when the asset is sold, even though you know that the value has increased for things like land and building, because they do not depreciate, they appreciate, but you are not allowed to record an increased value. According to the general accepted accounting practice, you must always show the cost price, the price that you paid for that particular asset. So this then brings us to the end of question 5.3, mean due limited, which was based on fixed assets. And learners are encouraged to go through the fixed asset note, because this note, it has proved to be giving learners a little bit of a challenge, especially when it comes to the calculation of depreciation, assets sold, and asset that was purchased during the year. So we strongly encourage students to practice this note. Make sure you go through it. You have your question paper, you look at this video, you go through it with me together, so that we make sure that we fine-tune the calculation of all missing amounts in the fixed asset notes. Thank you very much.